you worried you may be selected for an audit? Do you wonder if there's anything you can do to reduce the red flags? About 1% of all tax returns are audited each year. Here's what you should know in order to minimize your chances of an audit. Number 1, not reporting all taxable income. Report all taxable income from W-2s and 1099s you receive. The IRS receives copies of your W-2s and 1099s, so a mismatch on your reported income will immediately raise a red flag. Number 2, too many charitable deductions. The IRS takes into account the average donation at all income levels, so make sure your charitable deductions are not disproportionately large compared to your income. The larger the contribution, the more supporting documentation may be required. Number 3, claiming day trading losses on Schedule C. In order to report trading losses or expenses on Schedule C, you must qualify as a trader and not an investor. Traders buy and sell securities frequently, and their activity is continuous. Investors profit on long-term appreciation and dividends, and thus must report expenses as a miscellaneous itemized deduction on Schedule A. Number 4, claiming rental losses. Those who actively participate in renting property are allowed a deduction of up to $25,000 of loss against other income, as long as the gross income does not exceed $150,000. If you materially participate in real estate as a developer, broker, or landlord and spend more than 50% of all working hours and at least 750 hours per year, you can write off losses without limitation. Number 5, deducting business meals, travel, and entertainment. Most underreported income and overstated deductions are done by the self-employed. If you are self-employed, be careful not to mix business with personal transactions and keep detailed records of each business item. Business meetings must note who the meal was with and the purpose. Entertainment expenses are no longer deductible. Number 6, claiming 100% business use of a vehicle. It's difficult to claim 100% business use of a vehicle without raising red flags unless it's part of a fleet and parked at the business during off hours. Keep a log of your mileage, showing business and personal miles used for each trip. As an alternative, you can use the IRS standard mileage rate. However, you won't be able to claim any out-of-pocket expenses, such as maintenance or insurance. Number 7, writing off a loss for hobby activity. If you receive income from a hobby, you must report it. The expenses you incur can be deducted up to that income level. However, the IRS does not allow writing off losses from a hobby. Number 8, claiming the home office deduction. If you have a home office, you can claim the space and deduct a percentage of the related expenses, such as rent, real estate taxes, and utilities. You can also opt to use the standard rate of $5 per square foot of space with the maximum deduction of $1,500. Regardless, the IRS requires that designated office space be used for business purposes only. Be sure you have a dedicated space set aside as an office. Using a kitchen table or the couch doesn't qualify for this deduction. Number 9, taking an alimony deduction. When certain rules are met, alimony is deductible for the payer and taxable for the receiver. Alimony does not include child support or non-cash property settlements, and payer's liability ends when the former spouse dies. Make sure you satisfy all the requirements when deducting alimony. Number 10, running a small business. For small business owners in cash-intensive businesses, maintaining detailed records of all transactions is of utmost importance. Businesses with cash revenue are less likely to accurately report all taxable income, and as such can be an easy target for the IRS. Number 11, not reporting a foreign bank account. There are severe penalties for those who fail to report foreign bank accounts. If you have any foreign accounts totaling more than $10,000 at any time during the previous year, make sure you file FinCEN Form 114 by June 30th. Large cash transactions. Banks are required to report cash transactions larger than $10,000, as well as large cash transactions that look suspicious. Depositing large cash amounts, even if slightly less than $10,000, within a small time frame will likely prompt your bank to report suspicious activity. And number 13, making a lot of money. Those reporting $1 million or more of income are slightly more likely to be audited. Those with income of $200,000 or higher have an audit rate of 2.71%, compared to those making less and having an audit rate of only 0.78%. So be aware that the more you make, the more important it is to practice good bookkeeping. Be sure you understand the implication of each of these red flags. If any apply to your business, be sure you keep all related documentation to prove your position in the event you are audited.